stop checking Bitcoin's price. Seriously, just for a minute. While millions of investors are glued to the charts, riding the insane waves of crypto volatility, the sharpest minds on Wall Street are quietly piling into a completely different kind of asset. It's an asset that powers the entire crypto ecosystem, but it isn't a coin. They've figured out that in a digital gold rush, the real sustainable money isn't in speculating on the gold itself. It's in selling the picks and shovels. In the next few minutes, I'm going to show you exactly why the hardware companies that power Bitcoin, companies like CleanSpark, Bitfarms, and Marathon Digital, are becoming Wall Street's new favorite crypto play. And more importantly, I'm going to reveal how their secret pivot to powering the AI revolution is creating an explosive new and far more stable asset class that could leave Bitcoin's famous volatility in the dust. You're not going to want to miss this. Let's be honest. If you've been in crypto for more than 5 minutes, you know the feeling. That gut-wrenching 3 a.m. anxiety when you roll over, grab your phone, and see your portfolio is down 20%. Again, the high of a bull run is incredible, but the brutal, soul-crushing corrections are the part of the deal nobody likes to advertise. Bitcoin is a revolutionary asset, no doubt, but as an investment, it can feel less like a strategy and more like a full-time job managing your own psychology. You're constantly fighting a storm of emotions. First, there's the FOMO, the fear of missing out. You see headlines about teenage millionaires and you can't help but wonder, did I miss the boat? That feeling pushes you to make impulsive decisions, buying at the peak of the hype, only to watch in horror as the market turns on a dime. Then there's the FUD, fear, uncertainty, and doubt. Every day brings a new headline that could crater the market. A regulatory crackdown, a critical tweet, a security breach. The story can flip from Bitcoin is the future to Bitcoin is a failed experiment in a single news cycle. Trying to navigate this is like trying to sail a tiny ship in a hurricane. You're tossed around by forces completely out of your control. And the volatility, it's the defining feature of crypto. Fortunes are made and lost in the same week. For the average person, someone with a job, a family, and a life outside of staring at price charts, this isn't just stressful, it's unsustainable. You can't build a long-term plan on an asset that can lose half its value while you're on vacation. You're told to hodl, hold on for dear life, but that's easier said than done when your life savings are swinging by thousands of dollars every day. This relentless cycle has left countless investors burn out. They believe in the promise of decentralization, but they're tired of the casino. They're looking for a smarter way to get exposure to this tech revolution, a way to get the upside without the constant threat of a catastrophic loss. They want something grounded in the real world, something tangible. What if I told you that investment has been hiding in plain sight this whole time? During the California gold rush in the 1850s, a few lucky people struck it rich finding gold. But who made the most reliable fortunes? The people selling picks, shovels, and wheelbarrows. They weren't betting on a single miner's luck, they were betting on the gold rush itself by providing the essential gear. This is the most important analogy for understanding Wall Street's new obsession. In the digital gold rush of crypto, Bitcoin miners are the ones selling the picks and shovels. So, what does a Bitcoin miner actually do? Simply put, these companies run massive data centers packed with specialized computers. These computers, known as ASICs, work 24/7 to solve complex math problems. This mining process does two critical things. It verifies and adds new transactions to the Bitcoin blockchain, and it secures the entire network from attack. For providing this service, miners get paid in brand new Bitcoin. For years, investing in mining stocks was just a riskier bet on Bitcoin. When Bitcoin's price went up, mining revenues soared and their stocks often shot up even faster. When Bitcoin's price went down, they got crushed. It was still a volatile game, but with one huge difference. You weren't just buying a digital token. You were buying a piece of a publicly traded company with physical buildings, real revenue, and a balance sheet. You were buying a business. Companies like Marathon Digital, Mara, CleanSpark, CLSK, and Bitfarms, BITF, became giants. They weren't just a few tech bros in a garage. They were industrial scale operations mastering the logistics of finding cheap power, deploying hardware, and managing data centers worldwide. They raised billions, got listed on the NASDAQ, and started acting like major tech companies. This is the picks and shovels play. Instead of just betting on a coin's price, you invest in the network's foundation. You're betting that as long as Bitcoin is relevant, the need for a secure network will exist. But even this model was still shackled to crypto's wild price swings. The 2024 Bitcoin halving, which cut miner rewards in half, put immense pressure on their profits. For many, it felt like an existential threat. The market started to wonder if the pick and shovel business was even built to last. And this is where the story gets really interesting. Because these companies didn't just cross their fingers and hope for a Bitcoin rally. They looked at what they had built, their most valuable assets, and realized they weren't just in the Bitcoin business. They were in the energy and computation business. And it just so happens that another technological revolution was starting to boil over, one with an even bigger appetite for energy and computation than Bitcoin artificial intelligence. To get the genius of this pivot, you have to understand what these Bitcoin mining companies really are. Forget the beanbags and ping pong tables. Think more like a utility company or a heavy industrial operator. Their core business isn't just computers, it's power, massive industrial scale power. Bitcoin mining and AI training have one critical thing in common: they consume an almost unimaginable amount of electricity. Miners have spent a decade becoming world class experts at securing huge amounts of power at the lowest possible cost. They don't just plug into the grid, they build their own substations, forge direct deals with power plants, and set up shop in places with surplus energy, often from renewables like hydro, wind, and solar. Companies like Iran and CleanSpark have collectively secured access to over 14 gigawatts of grid-connected power. For perspective, a single gigawatt can power hundreds of thousands of homes. This pre-secured power is their golden ticket. Today, with AI demand causing gridlock and multi-year waiting lists for new data centers, having power-ready sites is an incredible competitive advantage. But it's not just having power, it's managing it. These companies run high-density facilities with advanced cooling systems to handle the intense heat from thousands of computers running at full blast. In short, they've spent years building the perfect environments that the AI industry is now desperately searching for. Take a look. Bitfarms operates hydro-powered sites for clean, low-cost energy. Marathon Digital operates 16 data centers on 4 continents, many powered by renewables. CleanSpark started in energy technology, so they have a deep understanding of power optimization. These aren't just crypto companies, they are sophisticated energy and infrastructure specialists. They built these digital fortresses to mine Bitcoin, but in doing so, they accidentally created the perfect real estate for the AI gold rush. Wall Street is noticing, with firms like Bernstein calling miners critical partners for AI cloud providers. If you're starting to see the bigger picture, that this is about way more than crypto coins, that this is about the fundamental infrastructure of our future, do me a quick favor and hit that subscribe button. We're about to get into the most explosive part of the story, and you won't want to miss what comes next. This is where the investment idea goes from interesting to potentially revolutionary. The meeting of Bitcoin mining infrastructure and the insatiable hunger of artificial intelligence is the secret sauce, the catalyst that's making Wall Street completely reevaluate this entire sector. So miners have the power and the buildings. AI companies have a desperate, almost unquenchable need for exactly that. It's a perfect match. The world's biggest tech companies are frantically racing to secure all the computing power they can, and they're hitting a huge bottleneck: a shortage of power-ready data centers. Enter the Bitcoin miners. They're sitting on a gold mine of digital real estate ready to lease. And that's exactly what they've started doing in 2 main ways. First, they're becoming high-performance computing HPC providers. They are installing high-end GPUs like NVIDIA's coveted H100s and renting that computing power directly to AI firms. Hut 8, for instance, launched a subsidiary called Highrise AI with over 1,000 NVIDIA H100 chips, offering GPU as a service. This gives them stable, recurring revenue from long-term contracts, a welcome vacation from Bitcoin's volatility. Second, they're just leasing their space and power, becoming specialized landlords for the AI industry. Core Scientific provides a stunning example. After its acquisition by AI hyperscaler CoreWeave was announced, the deal was projected to secure its infrastructure for AI operations. Prior to the acquisition talks, Core Scientific had already secured a 12-year contract with CoreWeave, expected to generate over $3.5 billion in revenue just by providing $200 million of its infrastructure. This kind of deal shows the immense potential, turning a miner into a key infrastructure player with a predictable revenue stream. The financial forecasts are staggering. Investment firm VanEck estimates that if public miners dedicate just 20% of their energy capacity to AI by 2027, it could generate an extra $13.9 billion in average yearly profits. The market is catching on. Iris Energy, IREN, which has pivoted aggressively, is targeting over $500 million in annualized revenue from its AI cloud business by early 2026. This isn't a side hustle, it's a fundamental business transformation. Bitfarms recently converted a debt facility into a $300 million project-specific financing deal to fund its AI data center development in Pennsylvania. CleanSpark, long known as a pure play Bitcoin miner, recently secured a $100 million credit facility to support investments in high performance computing. Even Marathon Digital is expanding into AI, with one goal being a more balanced revenue split between its US and international operations. This pivot does something crucial. It de risks the investment. By adding stable, long term contracts from the booming AI sector, these companies are no longer just slaves to Bitcoin's price. They're diversifying, smoothing out their earnings, and becoming resilient, hybrid energy tech companies. This is why institutional money is flowing in. They are no longer just miners, they are the backbone of two of the biggest tech revolutions of our lifetime. At this point, you might be asking, if miners are moving away from Bitcoin, isn't that a bad sign for Bitcoin itself? It's a fair question, but the answer is more complex. In many ways, this pivot could be one of the best long-term developments for Bitcoin's health. Here's why. A stronger miner means a stronger Bitcoin network. Historically, one of the biggest pressures pushing Bitcoin's price down comes from the miners themselves. Mining is an expensive business with massive electricity bills. To cover costs, miners have always had to regularly sell a lot of the Bitcoin they earn. When Bitcoin's price is low, this selling can create a vicious cycle, pushing the price down even further. The AI pivot breaks that cycle. By generating stable, predictable revenue from AI contracts, miners aren't at the mercy of the crypto markets anymore. This diversified income gives them a financial cushion. It allows them to cover their bills without being forced to sell their Bitcoin at bad prices. Instead of immediately selling, they can afford to hodl more of it on their balance sheets, which reduces the overall supply on the market. This financial strength also allows them to keep investing in their mining operations and upgrading their hardware. A healthy, profitable mining sector ensures the Bitcoin network stays robust, decentralized, and secure. And finally, it makes the whole ecosystem look more credible. When public companies build sustainable, diversified businesses, it attracts a new class of more conservative institutional investors. They might be hesitant to buy Bitcoin directly, but they're comfortable investing in an infrastructure company with real assets and multi-year contracts. This flow of capital is a powerful vote of confidence in the long-term future of digital assets. So, far from being a betrayal of Bitcoin, this evolution could ultimately strengthen its foundations. By building more resilient companies, miners are ensuring the long-term health of the very network they were created to support. Now, it would be irresponsible not to talk about the risks. This isn't a guaranteed home run, and there are serious challenges to consider. Remember, this isn't financial advice, and you have to do your own research. First, there's the risk of centralization. A core principle of Bitcoin is that no single entity is in control, but the AI pivot could threaten this. Building AI-ready data centers is incredibly expensive. An AI facility can cost much more than a comparable Bitcoin mine because of the pricey GPUs. This high barrier to entry could mean that only the biggest, best-funded miners can make the switch. If a few giants come to dominate both AI and Bitcoin mining, it could concentrate power in a way that goes against the crypto ethos. Second, there is execution risk. Having a great idea is one thing, but pulling it off is another. These companies are jumping into a hyper-competitive field against cloud giants like Amazon, Microsoft, and Google. While miners have a head start on power, they still need to build sales teams and learn to service demanding AI clients. Not every miner who tries to pivot will succeed. Third, there's competition among the miners themselves. If everyone rushes to pivot, they could create an oversupply of AI computing capacity, driving down the prices and profits. If everyone is selling shovels, the price of shovels will eventually fall. Finally, there are regulatory and market risks. The AI industry is attracting government scrutiny, and the huge energy use of both mining and AI remains a point of criticism. Stricter environmental rules could impact profits, and while the AI pivot reduces the dependency on Bitcoin's price, it doesn't eliminate it, especially for companies that run a hybrid model. It's important to weigh these risks against the rewards. The opportunity is massive, but the path is tricky. The winners will be the companies with the sharpest execution, the strongest balance sheets, and the best strategic foresight. We started with a simple idea. Stop obsessing over Bitcoin's price. What we've uncovered is a profound shift happening at the very foundation of the digital world. The once speculative Bitcoin miners are evolving. They're using their mastery of energy and infrastructure to become key players in not one, but two of our generation's biggest technological revolutions. They are shifting from a business model based on the price of a single volatile asset to a diversified model supported by stable, long term contracts from the booming AI industry. This isn't just a small tweak, it's the birth of a new kind of asset class, a hybrid infrastructure play that combines the upside of crypto with the real world demand of artificial intelligence. These companies are no longer just speculative bets. They are real businesses with hard assets, multiple revenue streams, and a clear path to growth that isn't totally dependent on the crypto market's wild mood swings. For investors who've been beaten down by volatility but still believe in the technology, this is a powerful new opportunity. It's a chance to invest in the picks and shovels of both the digital gold rush and the AI revolution all at once. But this pivot also leaves us with a huge question. Are Bitcoin miners about to become the essential backbone of the AI revolution, securing their place as the utility companies of the 21st century? Or are they selling out the decentralized dream for the stable, centralized profits of big tech? Let me know what you think in the comments below. And if you want to stay ahead of huge trends like this one, make sure you're subscribed with notifications on. Thanks for watching, and I'll see you in the next one.